the remainder of Chapter 4, and I also want to talk a little bit about some of the problems that you have coming up for this week as well. All right, so I left off on the previous video talking about alimony paid, and that is, if you're the payer of alimony, a deduction for AGI, and of course if you're a person who's the recipient of alimony or maintenance pursuant to either a divorce decree or a separation agreement, then you will report that as income. The 2018 tax year, however, will be the last year that the payer of alimony will be able to deduct it, and as well as the last year that the recipient of alimony will have to report it as income. So alimony must be as a result of a legal consequence. In other words, there must be a requirement to make cash payments only to the usually former spouse or a separated spouse. So these, in order to qualify as a deduction for AGI, these payments must be pursuant to the provisions of a decree of divorce, or as I said, a separate maintenance agreement. In the event the payee spouse dies, the payments must be so articulated in the agreement that they end at the payee spouse's death. I mentioned a few minutes ago that the recipient of the payments of alimony must report this income as gross income on his or her tax return. One thing that comes up, and I think is very interesting, is the idea of recapture of alimony. And in years past, folks who have gotten divorced and are getting along and cooperating have attempted to cast marital property within the settlement agreement as alimony. And so they could take a deduction on that and maybe share the tax savings between the two of them. And that's really not permitted. That's outside the intent of the deduction for alimony. And so if the IRS sees that the alimony payments have dropped suddenly after the first year or two, then it's going to appear to the IRS as though the initial year's alimony payments were not really alimony payments in the sense that we've described, but rather were property settlements that were taken as a tax deduction, and that's not appropriate. So the IRS will look at the substance over the form. That is, taxpayers may call it alimony, but if it's really not alimony in substance, then there may be a recapture. That is to say, once it's discovered, the IRS may make the taxpayer who took the alimony deduction that was really part of the marital settlement agreement, it'll take that deduction back and may have to pay in to the IRS based on the amount of tax savings realized from this over-reporting of alimony. So, but this would only apply in the event that the taxpayers really intended to take property settlement and recast it as alimony. If they're legitimate alimony payments in cash, then there's no problem, and then the payer can deduct them. Another deduction, again, this is for AGI. These are the important deductions in Schedule 1 of the Form 1040, is that educator expenses of up to $250 for qualified expenses can be deducted for AGI, and if the person is married, you can double that amount, assuming that both spouses are educators as well. Next thing I wanted to go over briefly was just to take a look at some of the problems that you have coming up in the next week's assignment. One relates to this, again, the deductibility of self-employment I mentioned earlier. And so one of the things I talked about during the PowerPoint is I mentioned that, and I'm going to make this a little bit bigger so it's a little bit easier to see. One of the things I mentioned was that a self-employed person certainly can deduct from their earnings self-employment income that they pay, or certainly up to the amount of their self-employment income. But they can't deduct any more than that. And so the idea here is that you'd compare the monthly health insurance benefits paid and you would compare that on a monthly basis to the amount of self-employment income. And in the event that you take the minimum of these two, so if they, for example, in this example, if they paid health insurance for the full 12 months, then you'd multiply 320 monthly rate times 12 months and compare that to the $3,400 of self-employment income, and you would take the minimum of those two. So we can't take a deduction that exceeds the income it's designed to offset. Next thing I want to mention is the military deduction for moving. And one of the things I wanted to drill down on a little bit that I didn't talk about too much in the video, earlier part of the video, in the first video, was that some of these expenses that are incurred by military folks are not deductible. So for example, if the military personnel or the spouse engages in pre-move house hunting, those costs associated with that house hunting are not deductible for purposes of the military moving expense for AGI deduction. Lodging and travel expenses, not meals while moving, do qualify as moving expenses. And the cost of moving furniture and personal belongings also qualifies. So then, one of the things we look at is, first of all, did the person serving in the military receive any reimbursement from the military for moving expenses? And if they did, then those reimbursed costs would have to be netted against the moving expenses. So in this case, we have Fabian having moving expenses on his AGI return, and we have to look at his adjusted gross income. In this case, it's $35,500, and then what we'll do is we'll compare the lodging and qualified expenses, the lodging expenses, as well as the cost of moving the belongings, and those two sum to $4,700, and then so certainly that qualifies because that's less than the AGI number, and so the taxpayer, that is the military family that moved as a result of an order that was given, a requirement by the military, they can take this $4,700 deduction for AGI on Schedule 1 of Form 1040. If you have any questions on these problems or any questions or concepts in the chapter, please let me know.